Costs and costs of production, week 5. These slides consist of 2 parts. In part A, we will discuss costs and economic profits. That section is broken into the following: costs and economic profit, costs, explicit costs versus implicit costs, economic profit, and accounting profit versus economic profit. Part B, titled Costs of Production, covers the following: costs in the short run versus costs in the long run, the principle of diminishing returns, the shape of the total product curve, the marginal cost definition and formula, fixed versus variable costs. Part B also covers short-run total cost, average costs and MC graphs, the relationship between marginal cost and average total cost, costs in the long run average cost phases. Part A, costs and economic profit. In order to understand the concept of economic profit, you first must understand the concept of opportunity cost. Opportunity cost is a concept that we have covered in previous slides. What is opportunity cost? Well, the opportunity cost is the opportunity that you lose by making a decision. So if you make a decision, the next best alternative that you could have chose is the opportunity lost, or the opportunity cost. So how do we calculate economic profit? Well, economic profit is equal to the total revenue minus the economic cost. We can calculate the total revenue by multiplying the price per unit by the quantity sold. That is the total revenue. We can calculate the economic cost by considering both explicit costs and implicit costs. So the costs of the inputs used in the production process, which are both explicit, meaning costing money, and implicit, meaning opportunity costs, costs for other uses. So the explicit costs are those costs which require money to change hands. Okay, so explicit in this case means visible or clear costs. Okay, so in general for production, you will be paying money for things like labor, somebody's work, capital, that would be interest payments on a loan, for example, will be paying money for capital, and for materials that are needed for production. Okay, is there an opportunity cost for the money spent on these things? So when you are investing capital, for example, you need to think, is this the best way to invest capital for this company? If there's a better way, then that should be chosen, right? But when there's an alternative way of using these material, labor and capital, the second most preferred use for these things would be the opportunity cost. That's what you cannot do with the labor, capital and materials, because you've chosen to do the particular production that you've chosen to do. Okay, so yes, there's always an opportunity cost, and as economists or students of economics, we'll need to consider the opportunity costs as well. Okay, but they're not the explicit costs. The explicit costs cost money. The implicit costs, on the other hand, are the opportunity costs of the inputs. Okay, so these opportunity costs do not require a money payment. They're implicit, meaning they're not as obvious necessarily as the explicit costs. So a nice example of an implicit opportunity cost is an entrepreneur's time. If I were to start a company, I would most likely have to give up my job so that I can spend the time focusing on building that company. Okay, so in that case, the opportunity cost would be my salary. So the salary would be foregone. I would give up the salary in order to focus the time to run the company. So the opportunity cost in that example is the money that the entrepreneur could have earned working for somebody else, gaining a salary. Okay. Now the entrepreneur also is investing money into their enterprise. Okay, and that money could have been used for something else. The most, let's say, easy to explain example might be just getting interest in the bank. Okay, so if the entrepreneur didn't invest money in their business, they would get interest from that money in the bank, and they have to forego that interest. They give up the chance to make that interest. So that interest that they're foregoing on the money that they invested in their enterprise, in their company, that is an opportunity cost. And these opportunity costs can be described as implicit costs because they're not obviously accounted for in the accounts of the enterprise as costing money, but they are costs. So here we see that example elaborated a little bit. The explicit costs are given in this table of accounting costs. Yeah. So the payment for labor, capital, and materials is covered in this accounts. Yeah, and it's clear. It's a clear cost that is landing up in the accounts. So it is an explicit cost. Okay, it requires money. Okay, but there are two other costs here, implicit costs, that we mentioned in the last slide. The entrepreneur's time, which could be valued in this example as 5,000, and the opportunity cost of the funds. That's the interest perhaps that the funds could make being put to a different use. Okay, you could say they could be invested in company stock in a different company, for example, and they might return some kind of dividend payment as well. That might be possible. So these two costs are implicit costs. So when calculating the economic cost, we must include the explicit cost here, 10,000, and all of the implicit costs. So the total economic cost in this example is 17,000, whereas in the accounts, we only have the explicit costs showing up because they're the ones that require the transfer of money. So the accounts are only showing costs of 10,000. So that's a significant difference, 17,000 in this example compared to 10,000. So that shows you quite clearly, that example, that economic cost is not the same thing. It's not equal to accounting cost. Okay, so in the accounts, it will only show things that require the payment of money. Yeah. So an accounting profit will be calculated by taking the total revenue and subtracting the accounting cost. Okay, it will not include the implicit cost, which is the opportunity cost. So this shows that an economic profit that a firm might make will look a lot less than the accounting profit, because the accounting profit is not taking into account these implicit costs, which are eating into the economic profit.